All right, everybody. It looks like we are live. Welcome to this week's live webinar. I'm Blake Schwanet. We'll get moving here in just a moment. I want to let a few people hop on and we can get started. Looks like we've got a few joining us. So I'll get started here in just a moment. For those of you that don't know, my name is Blake Schwanet. I'm a real estate investing coach and a real estate investor. So oftentimes those two things don't go together. Some people tend to lean on the laurels of previous years investing, but what you need, if you're going to have a coach anywhere, they need to have practical understanding, practical knowledge. And so that's what I do. I invest and I coach at the same time. Welcome to this week's live webinar. We've got a few people joining on from multiple different platforms. What we're going to talk about today is we are going to talk about how to find money for your real estate deals. And that is, see Marquez on here with us. The ability to find private money or money in general for your deals is a big deal because it allows you to go places that otherwise you wouldn't be able to go. And so here's what I'm going to do. I'm going to talk you through a few things. I want to talk about why it's important. Some people believe that you should only buy properties outright. I disagree with that, and I'll tell you why. I'll tell you why it's important. I want to tell you your options. A lot of people say, I don't even know what my options are and what the differences are between them, right? What's the difference between a Heloc and maybe seller financing or other things like that? I want to go through that with you. And then I'm going to give you some really practical pro tips on how to convince people to actually lend to you. Okay, so I'll give those to you at the end. I see a few more people hopping on here. This is great. Welcome to this week's webinar on how to find money. So one of the ways that I'm going to do this is once we get to the point where I talk through all of your options for lending or all of your options for financing your deals, I'm actually going to send in the chat, I'm going to send you a link to a few different options or to a slide that way you can follow along with me. And I'll send that to you so that you've got access to exactly what I'm looking at. Okay? So that's what I'm going to do. But first, I want to talk about why it's important. All right. So, I mean, I can't stress this enough. Why it's important to not just use your own money. Using your own money is just straight up, it's not scalable. It's not sustainable either. For example, if you let's say you live in a market where the median home price is $200,000, which that's a reasonably cheap market. That's a pretty inexpensive market. Not everybody lives there, but if you did and you bought something, if you didn't finance it at all, you got to show up with $200,000. Right? If you finance it, you have to show up with probably $45,000 to close, 20% down plus a few $1,000s for closing costs, both title and lending agency closing costs. Right? That's a lot of money down. And one of the challenges that a lot of people experience in real estate investing, even before they even start, is they feel like, well, it takes money to make money, and I don't have any money, so I guess I just can't invest. And we addressed that a lot last week. If you're interested in learning how to buy a house with low or no money down, go watch last week's webinar. Okay, I taught you how to buy a house with low or no money out of pocket. All right, sounds too good to be true, but if you got a little bit of hustle and a little bit of knowledge and process, you can do it. It's completely doable. So you need to use other people's money, or as you'll hear me refer to as OPM. Okay, when you see OPM, that means other people's money. All right. So it's just not scalable to use only your own money. Most people don't. I'm not here to help specifically, inherently wealthy people develop generational wealth because they've already got it from previous generations. What I'm here to help is I'm here to help people who are trying to get started developing passive income and generational wealth and help them get there, pulling themselves up by their bootstraps. Right. So it's just not sustainable. If you're in that situation, it's not scalable. It's not sustainable. And so I didn't start where I'm at. I was able to build a multi-million-dollar portfolio within 18 months and retire at 32. I said bye to my W-2 and I left. And now what I do is I split my time between growing my portfolio and teaching people how to do it. But it didn't start there. I actually kind of fell into real estate. And when I bought my first house, really I bought it because I was tired of moving around. I was a bachelor at the time and I rented it out to my other roommates. So I had a 4-bed, 2-bath in Austin, Texas. I rented it out to my roommates, and that more than covered my mortgage. That is a concept called house hacking, where you live in a property. Because you're living in it, you don't have to put 20% down. I put 5% down, and I let my roommates essentially pay for it. Right? And then when I sold that property years later, I actually made more on the profit than the house was worth when I bought it. So I bought it for 250. I made more than 250 on the sale years later. So that's powerful. But I didn't know when I bought the house that it was going to turn into that, right? I had no idea. There's no way I could know, right? But what I did was made a good decision, and then I compounded that. A year or so, about 18 months later, I house hacked another house. I bought up near where $1 billion Apple facility was going in. Great neighborhood, great area, and I house hacked that house. And then at that point, I started to catch the bug, and I wanted to scale faster. But Austin was not a cash flow market. My priorities still to this day are one, top priority is cash flow. Second priority is low price of entry, so a low entry point. And third priority is moderate appreciation. Those are my goals. And Austin didn't fit those goals. They just straight up did not fit those goals. And so what I had to do was adjust. I had to come to a different, look at it through a different lens and adjust my strategy. And so I started looking at, well, what markets would allow me the convenience of a reasonable price point, right? A reasonable price point, cash flow, and moderate appreciation, right? Because I saw all these awesome markets that cash flowed great, but I didn't live there. So I kept thinking to myself, oh man, I invest in Abilene now. I said, man, all those lucky people in Abilene. And my friends would say, why don't you just go invest in Abilene? Why don't you go live in Abilene? I said, well, I kind of like Austin. I like the parks and everything going on, the great food, the tacos, the barbecue, all of this stuff, the live music, the jazz music. And they said, well, you can't have your cake and eat it too. Well, in this case, I kind of could because I started investing remotely. And what I learned was you can optimize for those things. You control the variables that you can control, like the things that you would be doing if you were investing in your town, right? What would you probably do? You probably hire a contractor so that you don't spend all of your days doing that and fixing up the property. You'd hire a contractor. You'd probably swing by the property every now and again. You take pictures and videos so that you can look at them later. You just need to outsource that and find somebody to do that for you and replace yourself in these markets. There's certainly some nuance to it, but that's something that you can do. And then from there, I was able to scale to the point where I could retire at 32. And so the crux of all of this is that I didn't use my own money because I didn't really have any money. We didn't grow up, we had worlds more than my father did. And my father grew up in a trailer in Jersey, and they split bunk beds between 4 kids. And so we didn't have a whole lot growing up. And my dad's given us more than we ever have, but we weren't just rolling around in a bunch of money. And so I had to figure out a way to get creative and scale. And the key to that was other people's money, using other people's money. You and I have the luxury. If you're watching this, there is a high likelihood that you're in the United States. If you're in the United States, you are a lucky dog because almost 25% of global economic activity goes through your country. It goes through the United States. So it's not that money's not out there. It's just that you can't find it. Money is out there, and it's actually easier to find than you might think. 25% of global GDP, gross domestic product, going through the United States, almost. I mean, that is absolutely unbelievable. We live in the wealthiest generation in the history of the world. Right? In general, United States citizens don't have to worry about food, right? Contrary to, say, places like Ethiopia, which are really struggling with that. So that's a luxury that you have in the first place. So don't take that for granted. And don't use an excuse like, well, I can't get money. All right. Anytime you drive past a sign that says, I buy houses for cash, they don't actually have the cash. They're borrowing it in almost every situation. They're borrowing it from somebody else, other people's money. They don't use their own cash because they need to leverage. There is a difference between good debt and bad debt. A lot of people are in the Dave Ramsey camp, which is that all debt is bad. Dave gets a lot of things right. This is one thing that he gets wrong. All debt is not bad. All debt that is predicated on a liability is bad. But if it's predicated on an asset, it's good debt. Now all we've got to do is understand what's the difference between a liability and an asset. A liability is anything that takes money out of your pocket, right? New phone, a car, maybe. Even your primary residence in most circumstances is a liability. Anything that takes money out of your pocket. An asset, on the other hand, is anything that consistently puts money into your pocket. So a real estate investment, an index fund, a any type of portfolio income, maybe a side hustle, a business that you run. All of those things are considered assets. So what you want to do is put your money in assets, not liabilities. And good debt is considered debt that's predicated on an asset. Okay? Hey, Israel, we're glad that you're here. Jimmy, I see your comment. Mark Hay, good to see you. It's good to see everybody joining. But that debt predicated on an asset is a good thing because that asset's going to continue to bring you money. Okay? When it's predicated on a liability, it's bad debt. And that there is a fundamental difference between those two things. If you can take out a mortgage that you only have to pay $400 a month for and rent out that house for $1,200 a month, not only do you have the extra $800 a month, you've got some expenses in there. So let's say it's $400 a month, actual walking around, going to dinner, vacation money. You have that additional money for you to walk around and do things with. On top of that, you have a tax shelter because of that $400 payment, let's say $200 of it's going to interest. $200 of that's tax write off. You can write that off. The principal pay down is one benefit that other $200 of the payment is going to principal. So it's essentially going to your savings account. It's a little bit harder to access, but you can access it. And we'll talk about ways that you can access it here in just a moment. But you can access it and it's your savings. In addition to that, if the house appreciates, that's your money as well. So if you only owe $70,000 on a house, but it's worth $140,000, you have 70 grand there. And you can access that in different ways other than selling it. You don't have to sell your house to get access to a chunk of that money. Okay? So there is a very big difference between debt predicated on an asset and on a liability. So debt is good. In general, like Robert Kiyosaki says, debtors are winners. And if you don't use debt, you're losers. Not because your identity is a loser, but because you're losing money. All right? Cash is losers. Debt, winners. If it's predicated on an asset. Okay? So I want to talk about what are your options. Okay? I'm going to drop this in the comments. Give me a thumbs up on this, a like on it if you get it. I just sent over a link that should say primary OPM options. Okay, give me a like or an up vote on it. That way I know that it made it there safely. Because this is what I'm going to walk through. I want to walk through some of your OPM options. Okay. I haven't seen anything come through, so let me know when you got it. And give me that like or give me another comment if you can see it. All right. Good. Thank you, Garrett. Appreciate that. Okay, so these are your options. Okay, you're going to be able to follow along. Okay, so if you click forward, you'll be able to see the next steps. Okay, so you can cheat and go forward. I completely approve of that. But I want to talk through them, so don't get distracted by this. So move at the same pace if you're having trouble getting distracted. Okay, now first thing I want to say is these are not all the options for financing. There are other nuanced ways to finance a property, like, for example, seller financing. Seller financing is where the seller owns the property outright, and they can essentially act as your bank. So you can negotiate whatever terms you want on that front, right? You could say, I'll pay you $500 a month for 80 years in order to pay this loan off. Right? You could negotiate that if you wanted to. That's seller finance. There's also subject to financing. Financing where the property might not be paid off. So what you do is you inherit the existing payments and you either pay them for taking over that property, or sometimes they pay you for taking over that property if they just need to get out of it and the sale costs for putting it on the MLS are too high. There's a lot of things like that. There's also note investing and other, all that to say, these are not the exhaustive list of options for you, but what they are the most significant options. They're the primary options for you. The first one, lending options, is a bank. We're all familiar with banks. Banks are institutions. And the way a bank works is people come to a bank, they put their deposits in or they put their savings in, and the bank uses that to lever up and borrow money, usually from the federal government or from other larger loan entities. That allows them to do what they do. And they give you 1% on your savings account, or honestly, normally 0.25%, because they can go out and make 6% on that money. And then they take the 5.5% and they're able to pay their people and make a lot of money. All right. That's what they do. Now, the reason I've got an asterisk next to this is there is a very significant difference between a national, multinational, global bank and a local bank. There's a significant difference between a local bank and a regional bank. And that's important to know. A larger bank, when you go to, say, Chase or Wells Fargo and you apply for a loan, you are metric. When you put in all your information and out spits a risk value, that risk value is usually correlated with your interest rate, or sometimes they say, we just won't lend to you. But that's all done from an algorithm. It's pretty much science on the back end. A local bank doesn't work that way. A local bank, you show up and you talk to somebody or talk to them on the phone, you say, this is what I want to do. And you talk to that loan originator, you say, I want to use some money from your bank in order to invest and flip a house so that it increases in value. That's a fix and flip loan, and banks will do that for you. Banks move slower, but they'll do that for you. You work with a local lender, they have a lot more say over what happens in the bank. So that local loan originator then goes to loan committee. Loan committee sometimes will happen every day if it's really busy. Sometimes it'll happen every week. But they will literally sit around a table with 6, 8, 10 people and decide how to invest the portfolio of money that they have. The reason I say that is it is very flexible, right? They're going there and they're saying you're competing against somebody like, someone wants to start a snow cone stand in Ontario, right? And they say, well, actually, I think this is a better investment because real estate's more consistent historically. And so lots of banks will have a certain percentage of their portfolio that's earmarked specifically for real estate because of the low volatility nature of real estate. And so local banks, what I want you to hear there is local banks operate fundamentally different than large banks. They have a lot more flexibility and sometimes can offer the exact same or better rates and competitive rates. Okay. So that's just, I want to say that outright. Usually what banks are optimized for is a long-term loan. So what I'm going to go through here in these 4 primary OPM options are their term. Are they long, medium, or short loans? Short-term loans, long-term loans, short-term loans, or medium-term loans. The way that I define long, short, and medium, short is 12 months or less. Medium is, say, 5 years, up to 5 years. And long is anything longer than that. Okay, we're going to talk about term because that's important. The other we're going to talk about is type. So is it principal or is it interest? Is it principal only? Is it interest only? Is it principal plus interest, or what you might hear as amortized? So spread out over a long period of time. And the other thing I think is incredibly important for real estate investors that are looking to buy low, sell high, right? You win on the buy. If you're going to buy low, oftentimes you got to move quickly. So I want to talk about the speed of money or the agility of the organization, the lending institution, or the lending individual. Okay, those are the things we're going to talk about. So a bank, because it's so significant, it's an institution, right? It's not an individual, it's an institution. It's a large institution. Because of that, it moves very slowly. All right, some of these things are optimized, but in general, the larger the organization, the slower it moves. So banks move pretty slowly. If you're trying to close in 30 days, that's great. You can probably do that. 30 to 45 days is really their sweet spot. But that is not, say, 10 days. If you're working with a wholesaler, usually they want to close in 5 to 10, sometimes 15 days. That is not what a bank is optimized for. But a bank does include principal plus interest payments. So one of the sweet spots of a bank is they can spread your loan out over a very long period of time, making your payment much lower. And while your payment's still lower, it also pays down principal. So a bank has its place, but on the front end of an investment, it's not usually optimized unless you're going to do a turnkey property and just put 20% down and ride it out. But if you're going to do the BRRRR model, we've got to get creative. We've got to come up with a different idea. The next option is a line of credit. And this is usually provided to you through a bank or or sometimes a smaller lending institution, maybe a federal credit union. But a line of credit acts similarly to a loan, but has a very specific difference in that when you're given a loan, let's say I give you a $100,000 loan. You start paying interest on that loan on day one. But if I give you a line of credit, you're not feed on that. You're not charged on any of that interest until you use it. Okay, so a line of credit would be money available to use for you at a specific rate. Line of credit rates could be anywhere from 5 to 6% right now. I think that's a reasonable range. The most common line of credit in real estate investing is what's called a Heloc, a home equity line of credit. So if you owe $100,000 on a $300,000 house, you have $200,000 of equity in the house. Now that's your money, and you can access that in very specific ways. But what some people say is, well, I've got $200,000 of equity, so I can use $200,000. And that's not the case because a lending institution is only going to lend you up to 80% of the value of your property. So if your property's worth $300,000, then you can only loan up to $240,000. And if you owe $100,000 of that, you're already loaned $100,000. The difference is $140,000. So you've got $140,000 that you can use rather than $200,000. It's a different number, but still really useful. So a line of credit, the sweet spot for them is long or medium terms. Now, or the term of the loan is long or medium. Well, maybe that's actually probably a typo because I moved some of these things around. Because HELOCs generally aren't used for long. It should read short and medium. And I can go in and edit that at some point so that when you read it later, you'll see it correctly. But line of credits you can use for a short term. You could use it as something to fix up your kitchen. You could use it to fix up your kitchen. You could use it to renovate your property or another property, and you're just gonna have to pay interest on that. Sometimes you can pay it back over a long period of time, but you can use it really quickly. You can pay it back quickly. Now, what you can't do is if you've got $140,000 listed out for your line of credit, if you take out a $40,000 line of credit, you've got to pay all that back before you access the rest of it. So take out the full line of credit if you're going to take out a line of credit, and then only use $40,000. Okay. Now, with lines of credit, they are inherently interest only. You're not paying down principal when you use this line of credit. They're primarily interest only. Now, you could pay back some principal here and there, but they're not going to be amortized the way that a 30-year or 25-year product is from a bank. One of the sweet spots for a line of credit is that it's highly agile, so it can move quickly. So if you've got a really good lending institution, you could find a property and call your lending institution and say, hey, can you wire over $100,000 for me to purchase this property? And then I'm going to fix it up. And they say, yeah, you could reasonably close in 2 days, 3 days, 4 days. Because a lot of the terms that slow down that process are based on the lending institution. So it's highly agile, which is one of the sweet spots of a line of credit. And lines of credit tend to cost less money. They cost less money than some of these other ones, like hard money. Hard money is generally oriented toward medium and short term. It's generally oriented toward short term. Now, the next one is going to be private money, and I want to distinguish between private and hard money because there's a lot of lenders out there right now saying, I'm a private lender, and they are not a private lender. The difference between a hard money lender and a private lender is one is an institution and one is an individual. A private money lender is a person, a human that has money in their bank account or in their assets that they can then lend, and they lend as an individual. Maybe they've got one representative, but they make all of the decision. Maybe they've got somebody who's their financial advisor that passes the money over for you or for them, but they don't have an extensive decision tree. They don't have a lot of hierarchy in their organization. They are an individual loaning. Hard money is an institution, albeit a smaller institution than, say, a bank. It could be as small as 3 or 4 people. But what they do is they go raise money from it's similar to syndicating, but it's a little bit more decentralized on the investment portion of it. So they go raise a bunch of money. They raise $50,000 here, $500,000 here, and they guarantee those people a certain return. And then their goal is to go make a delta on top of that. So if they guarantee 6% to their people, they want to go make 10%, and they take the 4% home with them. That's how they make money. So the reason I say this is important is because hard money and private money is just different. Private money, which I'll talk about later, is the sweet spot. If you don't have a line of credit, HELOC, or cash, private money is the ideal use of OPM for something like the Burr strategy. Okay, hard money can still help. In fact, I have a couple properties under hard money, but I want you to know the difference because there's a lot of people out there saying that they're hard money lenders and they're not. Generally, hard money lenders are oriented towards short and medium term. Short term fix and flip loans like a 12-month loan that you're only going to hold it for 4 months and there's no prepayment penalty. Or a medium term loan like a bridge loan, maybe a 2 to 5 year term with a step down prepayment penalty. Okay? You can then refinance those and pay them off into a long-term product, which is what the Burr strategy says, but they're inherently short and medium term. They're also only interest. So you're only going to be paying interest down on them. The other thing about them, one advantage to hard money over a bank is that they're faster. They can move a little bit more agile. The fastest hard money lender that I know of can close in 2 days because they do what's called a desktop appraisal. So they evaluate and appraise the property in-house. They do it essentially with their own technology. That's the fastest a hard money lender I know of can close. Usually they're 7 to 10 days, sometimes 15 days or longer. And if you're trying to close on a property quickly and a hard money lender takes 15 days or longer to close, you might as well just use a bank. And that's where it comes into play. Like you need to know what your options are for OPM so that you can have them in a tool belt and you can use them at the right time. So hard money lending moves pretty fast, but not lightning speed. Lightning speed is private money because it's an individual. Remember, hard money, institution, private money, individual. Private money is an individual that has money. Let's say they're sitting on $300,000 or $400,000, and they want to make some money off of that money. They want it to grow, but they don't want to put it other places for certain reasons, which we'll talk about in a minute. Naturally, it orients itself toward short-term investments. This is 12 months or less. Every now and again, you'll find a private money lender that will allow you to do a medium-term investment, but then you get into a point where private money rates right now anywhere between, say, 9 and 13%. If they're going to use their private money on a short term, though, they could make a higher return than if they put it into a medium term and charged, say, 6 to 8%. So most of them are oriented towards short term investments for other reasons that we'll talk about in a minute. Primarily, they are interest only loans. And there's benefit to that. You might say, well, why would I want an interest only loan? One of the benefits to an interest only loan is you're only paying interest on it. You're not worried about the mortgage. You're not worried about the amortization schedule. You're only paying interest on it. So one, it can lower your payment for short term. And two, you have some benefits in the way that you actually structure it. Like you don't have to worry about an amortization schedule. You don't have to worry. Taxes are simpler. That's all interest. That's another reason. But the primary reason why private money is so valuable is because it moves quickly. It moves very, very quickly. And so for some of the private lenders that I work with, I'll send them a text and say, I've got this property, here are some of the specs. I'll send you a report, some concrete details and analysis on it, and my own evaluation of it so that they know their security. And then literally the next day, they might wire money for me. That's how quickly this stuff moves because they make their own decisions. So if you want to be a private money lender, that's fine. What usually private money lenders say, I don't have time to do this, but I do want my money to grow. And so they want it to grow faster than maybe a CD or savings account might allow them for, but they don't want to expose it to the market, the volatility of the market. So they might do it this way. And so if you're interested in private money lending, feel free to reach out to me. I'm happy to talk to you about how to structure that because you don't want to go into it blind. So those are your options. You've got banks, a line of credit, hard money, and private money. I didn't list cash because we all understand cash pretty well. All right. So that's important for you to know. It's important for you to know these options. Again, this isn't an exhaustive list. I couldn't do that we're already 30 minutes in and I haven't even gotten to some of the other nuances of lending. So not everything, but some great options for you. Now, one thing I do want to comment on is banks. When you're looking at banks, part of the asterisk there is that banks will offer both conventional loans and commercial loans. So conventional loans is Freddie or Fannie backed loans. They're federally backed loans, which is why you can get such a low rate. So when the Fed lowers their rate, that directly affects conventional loans. They are different they have different rules than commercial loans. Now, when you hear commercial loan, normally you think of something that's loaning for a new Walmart supercenter that's being put in, or a gas station, or retail, or a large apartment complex, or a huge land development. But commercial loans also loan on residential property, which is fantastic. Even single family residential, not just triplexes or quadplexes, but single family residential. And they loan there. And there are some very significant differences between them. Okay. So I'll talk about them just lightly. I don't want to look at it through the lens of you, the lender, or the lendee, rather. Conventional loans, they care about two things. They care about your credit score and they care about your DTI. I'll explain that in a minute. The important thing to know here is they care about you. They care about the lendee, the individual. Okay, so your credit score is what it is. DTI is debt to income. You may be familiar with this term. This is essentially how much per month, how much debt you have per month that you have to pay, debt obligations, so any school loans, mortgages, rent that you've got to pay, those things that you have to pay, versus divided by your income, your monthly income. That number can't be over 50% if it's a conventional loan. Those are the rules of conventional loan. So when it's federally backed, the federal government gets to define some of those regulations. That's what they've said is you can't have over 50% because they're trying to prevent what happened in 08, 09 again. So they care about your credit score and DTI, debt to income. Commercial loans, so if you're saying, well, my credit score sucks or my DTI is too high, I've already got 10 properties. There's a limit to how many properties you can have on a conventional loan, even if your DTI is incredible, it's negative percent, right? There are limitations on how many conventional loans you have. So even if your credit score is bad, even if your DTI is too high, or you've got too many loans, there's commercial loans. This is an option for you. One of the sweet spots of commercial loans is that they don't care about you. They don't care about you, the lendee. They care about the asset, what's backing and securing the loan. And that's incredibly valuable. So they don't care about DTI. They care about what's called debt service coverage ratio. The debt DSCR, or debt service coverage ratio, asks the question of the debt that I'm giving them, how much does this property cover? So if you're taking out a loan, say on a $120,000 property, and your payment is $500 a month, and you rent that property out for $1,000 a month, 1,000 divided by 500 is 2. So that's a debt service coverage ratio of 2. Usually the lenders that I'm looking into, that I'm talking with on the commercial side, they're looking for a debt service coverage ratio of anywhere between, it's different by lending institution, but anywhere between 1.1 and 1.35. So if you're looking for an investment for cash flow purposes, you're in good shape. That's a good situation for you because the debt service coverage ratio is high on cash flow properties. What they're doing here is trying to hedge their bet for people that don't know what they're doing, and they buy a house for cash flow purposes, but then they find out they're not able to cash flow it, right? They're not able to cover the mortgage. That works if you're, just individually rich and you've got a bunch of money sitting around, but it doesn't work if you're trying to scale large and you're not just sitting on a bunch of cash, right? So that's the difference between those two things. What I'm hoping that you understand from that is just because you got bad credit does not mean you can't get a loan. If you find a good product, you find a good house, a good investment, someone will fund that loan. You just have to go find them. Now, there are a few other differences in conventional and commercial. One of them, I'll hit on the primary two. One is you pay a higher rate for commercial, maybe about a point higher, point and a half higher. But if it's amortized over the right term, it doesn't really matter. The second thing is amortization schedules become trickier. So I would say 90% of commercial lenders don't want a loan past 20 years. Maybe you can find 25, but the other 10%, they'll loan up to 30 years. You can get a commercial loan for up to 30-year amortization and 5% interest, 4.5% interest, depending on the market rates. And those are the primary differences. So just because you can't find a 30-year AM doesn't mean you should settle. Just keep calling more lenders. So those are some of the specific details about the differences in banks, because that's important to know, the differences between conventional loans and commercial loans. So what I don't want to hear is no one will lend to me, because the answer is they will. You live in the United States. We have a bunch of money in the United States. You just have to go find it. Now, I've given you a bunch of pro tips to date, but the biggest pro tip that I want to give you for lending, for finding a private lender, my biggest pro tip is know your value. Know what you're bringing to the table. All right. You're not going to be able to show up and just say, hey, pretty please, will you give me $100,000? That's just not going to work. No one's going to do that. No one's going to loan to you, right? So you have to know the value that you bring to them, and you actually have to bring value to them. So let me tell you about the private lender and what they care about so that you can easily speak to, or more easily speak to, what they care about. A private lender, the people that I'm looking for to do private lending, care about three things. So think about somebody that, let's say they've got a few $100,000 in their bank account and they're not sure what to do with it, but they know they don't want it to sit in their bank account because they're only making 0.25% on it or maybe 1% on it. That's not enough. They're essentially losing money relative to the rate of inflation, right? Their purchasing power is decreasing when it's just sitting in the bank, right? But the other end of the scale is, and that's a low risk, low reward investment. The other end of the scale is a high risk, high reward investment, right? You've got something like the highest risk is venture capitalism, right? 98% of all startups fail. And not only that, when you put your money into venture capital, you fund maybe a startup, it's illiquid as well. So not only do you run the risk of it potentially failing, but you don't get the money back until they either sell or IPO. So that's not liquid. You don't get that back. Just south of that, the high risk, moderate reward could be considered the stock market. You've seen how volatile it is. With one tweet, everything can change, right? We've even seen that Reddit can control the market to a certain extent, right? So depending on your investing strategy, if you yourself are active trading, 99% of active traders do not outperform index funds. Index funds are generally 8-9%, right? And it's not going to outperform an index fund in general. So it's actually higher risk and lower return than you might think of the stock market. But in between there is something that's low risk, it's moderate to high reward, and it's high liquidity. Those are the three things that a private lender cares about. They care about something being reasonably liquid in case they need to use that money, right? I was talking to somebody recently who came into a bunch of money that had an incredible investment, and they said, it's just going to kill me to let it sit in my bank account. I said, well, why don't you invest it in some, high dividend funds or index funds or something like that? They said, well, I need it accessible within 3 or 6 months, just in case something happens with other investments that I need to move around. And so they want to make more than the 1%, but they don't want to expose it to the market, right? And they need to have it liquid. So that's one thing they care about. The second thing is they don't want to lose money. People are actually more scared on the whole of losing money than they are of not making what they could have made. They really want to, we're just protectors. Your brain in general it's not designed to make you happy. It's designed to protect you and help you survive. That's how we're designed. So when we see something scary, we generally assign and attribute certain things to it that protect us from it. We don't tend to naturally run through it. That takes some skill and some practice. And so when you see that investment, when people leave money there, it's because they want to protect it. They're not as concerned about watching it grow. They're more concerned about protecting it and making sure they don't lose it. All right, so they care about a moderate return. They really don't want this, but they also don't want the high volatility. They don't want to just let it sit there, but they don't want the high volatility. They also want protection. They want security because, again, they don't want to lose their money. And the importance of what you can offer to them is an asset secured loan. It's actually very, very secure. It's much more secure than stocks even would be, depending on the asset, if you pick the right asset. Because if you take a loan from them for a specific property, they get first lien on that property. So let's say you buy a $50,000 house, you put 20 into it, now it's worth 100. And they loaned you the $20,000, the $70,000 up front, and you don't pay them back, they get the property. Now they own an extra $30,000 for no effort of their own. So what they might perceive as their worst case scenario is actually financially their best case scenario, right? Now there's some operational overhead that goes into them saying, I don't want to sell a property, I don't want to go through all that stuff, but they make a lot more money that way, right? So it's very, very secure, and you have an invested interest in getting their money back to them, right? So those are the three things they care about. They care about security, they care about liquidity, and they care about their return. And they're looking for a very specific, you're looking for a very specific person. Okay, so here's what I want you to do. when you interact with these people, I want you to, one, know your value. Make sure that you know that you have a strong value proposition, because your value proposition is, I tell you what, I can give you a certain return, X amount of return, 8, 10, 12, sometimes 14, 16% return, depending on the property. I can give you this high return with security and liquidity. And if that's what you're looking for, great. So that's one. That's how you can help them. But think in terms of, when you're talking to them, think in terms of how you can help them and how you can protect them. So they want to make money, right? They want to make money on their money, but they don't have the time to do the BRRRR method like some of you might. So what they're saying is, borrow my money so that I can make money on that money, right? That's one way that you can help them. You can help them make more money in a more secured way than other investments might, and you can protect them from them losing it because it's asset secured. So those are the things you've got to know. You've got to know your value proposition. You've got to know how you can help them, and you've got to know how you can protect them, which is incredibly valuable for interacting with private lenders. And if they say no, that's great. And if you make calls to private lenders, I'd say 9 out of 10 people that I call, every single time they say no. For one, maybe it's because they don't have money, or maybe it's because it's not a good time, or it's, COVID hit them in an adverse way. That's totally fine. But that one will help you scale, right? We talked about one of the benefits of the BRRRR model being recycling that money. That's a big deal, incredibly valuable, right? So continue at it. Go find that money for your investing. I appreciate you guys joining. That's what I've got. I'll let you guys keep that link to those resources. I'll go update what we talked about on the webinar, the funding resources, the OPM resources, to make sure it's the right, accurate information for you guys. If you guys have questions, feel free to put them in the comments. If you want me to talk about something specific next week, put those in the comments too. I'm happy to work that into some of the information that I put together. And then if you want to get in touch with me, again, I'm an investor and an investing coach specifically for real estate. If you want to get in touch with me, check out my website at blakeshwane.com. You can also, in the slides that you're looking at, the logo at the bottom, you can click on that. It'll take you to my website, and you'll be able to get more information there. So I appreciate you guys coming. We'll see you next week. Happy investing.